Welcome to Section 4 of the ASC 405 Liabilities Training Series. In this section, we will walk through exactly what it takes to remove a liability from your balance sheet under a SC 400-520, the rules on extinguishment. Let us get started. By the end of this section, you will be able to define what extinguishment means and explain why legal release is the central requirement. You will distinguish between legal defeasance, which does extinguish a liability, and in substance defeasance, which does not. You will calculate the gain or loss on early extinguishment using carrying amounts and repurchase prices. You will record the correct journal entries, and you will know exactly how to present extinguishment gains and losses in the income statement. Here is the central question you should always ask. Has the debtor been legally released from this obligation? That is the entire test under a SC 400-520. Extinguishment, or derecognition, means the liability comes off the balance sheet. But the trigger is not payment or intent to pay. The trigger is legal release, granted either by the creditor directly or through a formal legal process. Most people assume that setting funds aside to cover a debt removes the liability. Watch out for this one. It does not. The liability stays until legal freedom is confirmed. Let us look at the scenarios where extinguishment actually happens. First, full payment to the creditor discharges the obligation straightforward. Second, if the creditor formally forgives the debt, that is a legal release and the liability is gone. Third, legal defeasance. The debtor places acquired securities into a trust that automatically funds repayment, and the debtor is legally released from being the primary obligor. That qualifies. Finally, if a company repurchases its own bonds in the open market, the debtor and creditor become the same entity, so the obligation simply ceases to exist. The surprising part is how often teams believe a liability has been removed when it legally has not. The most common trap is in substance defeasance. Here, the entity places assets in trust specifically to service a debt. The trust makes the payments, and everyone treats the liability as gone. But if the creditor never formally released the debtor, the entity is still the primary obligor, and the liability stays on the balance sheet. Similarly, transferring debt to another entity sounds like it should work, but without a legal release of the original debtor, the obligation remains. This is where things get interesting, because these two arrangements look almost identical on the surface. In both cases, the debtor acquires high-quality securities and places them in trust to generate the cash flows needed to repay the debt. The difference is entirely about legal status. In legal defeasance, the creditor formally releases the debtor from being the primary obligor. Extinguishment occurs. In substance defeasance, there is no such release. The debtor is still on the hook legally, even though the trust is funding the payments. Your liability stays. The trust arrangement by itself changes nothing. Here is the key thing when it comes to measuring extinguishment. You need the carrying amount of the liability on the date of extinguishment. Start with the face value of the debt. Add any unamortized premium, then subtract any unamortized discount and any unamortized issuance costs. That net figure is your carrying amount. Then compare it to the repurchase price, the cash you paid, or the fair value of any assets you transferred. If the carrying amount exceeds the repurchase price, you have a gain. If you paid more than the carrying amount, you have a loss. Watch out for this one in practice. You must remove every related balance, not just the face value of the debt. When you extinguish debt at a loss, debit the debt account at its full carrying amount, and debit loss on extinguishment for the difference. On the credit side, credit cash for the repurchase price you actually paid, and credit unamortized issuance costs to remove whatever balance remains. The journal entry forces you to clear all associated deferred costs in one step. Leaving any of those balances on the books after extinguishment is an error. For a straightforward full settlement paying off a debt at maturity or at negotiated terms, The entry follows the same logic. Debit the liability at carrying amount. If the cash paid exceeds that carrying amount, debit a loss on extinguishment for the excess. If the carrying amount exceeds the cash paid, the difference is a credit gain on extinguishment. You will never have both a gain and a loss on the same transaction. One side of that equation will always be zero. Keep the entry clean, remove all related balances, and tie the amounts back to your carrying amount calculation. Most people assume that a large, unusual gain or loss on debt extinguishment must be classified as an extraordinary item. That category no longer exists under current US GAAP. FASB eliminated it, so there is no separate section at the bottom of the income statement for these amounts. Instead, the gain or loss on extinguishment is presented as a separate line item within income from continuing operations. Your disclosure should identify what happened and quantify the amount. If the amount is material, investors and auditors will expect enough detail to understand the transaction. Do not bury it in a catch-all line. When your auditors review a debt extinguishment, 3 things are at the top of their checklist. First, the payoff letter or formal creditor release. This is the evidence of legal release, not simply a wire confirmation showing cash left the account. Second, a carrying amount calculation as of the exact extinguishment date, showing face value, premium, discount, and unamortized issuance costs. Third, the gain or loss calculation that ties directly to those carrying amounts and the repurchase price. Get the date right too. Derecognition happens on the date of legal release, and that date determines which reporting period the gain or loss hits. Here is a quick summary of where things go wrong. The most serious error is removing a liability from the balance sheet simply because assets have been set aside without confirming legal release. Next, teams often forget to clear unamortized discounts, premiums, or issuance costs, which leaves stale balances on the books. Using face value instead of the true carrying amount distorts the gain or loss. Classifying the result as extraordinary is an obsolete treatment. And finally, booking the entry in the wrong period, because the extinguishment date was not confirmed precisely, is a timing error that affects both the balance sheet and the income statement. Let us bring it together. Extinguishment under a SC 400-520 has one fundamental test: legal release. Whether the creditor grants it directly, a court enforces it, or a legal defeasance structure achieves it, legal release is what removes the liability. In substance, defeasance, no matter how well structured, does not cross that line. When you calculate the gain or loss, use carrying amount, not face value, and compare it to what you actually paid or transferred. Present the result as a separate income statement line item, and when you document the transaction, lead with the legal release evidence. Thank you for completing this section on extinguishment of liabilities. Thank you for watching. Subscribe for more training from PNJ Group.